Welcome and thank you to everyone who is joining our webinar. So maximising the profit and value of our practice, of your practice, presented by Hive Business and Christie & Co. So then some introductions to the team and who we have with us this evening. So from Hive, we've got Ross Martin, the group chairman.
Hello, welcome.
Thank you. And we also have Simon, our tax director.
Hi, everybody.
We've also got some experts from Christie & Co. So we've got Jonathan Watson.
Good evening.
And also Jamie Williams.
Evening all, thanks for joining.
And Christie & Co. deal with the with dental practice sales, acquisitions and funding. So Ross is going to kick us off this evening. He's going to start off by running us through the business of dentistry, where he'll then pass over to Jonathan and Jamie to go through the current state of the market. And then Simon will be finishing with some tax savings strategy. So Ross, I will hand over to you.
Thank you very much. Hello to everyone. What we've got this evening, a bit of a ground to cover there, as you can see, but what we're hopefully going to give you an insight of is a bit of a blended approach to how to kind of optimize your profitability and also get best case kind of outcome on an exit. Probably worth kind of saying, we think a good planning for an optimal exit for your practice, might be as much as 3 or 4 years to allow for many different components, including, kind of growth, pre-sale planning, tax planning, which Simon will talk about a bit later, and kind of timing a good point of the market as well to bring your practice to market. What we'll also say is that, some of the tips that we'll find here, what we're aiming to do tonight is to give you some, probably sort of some nuggets. Won't solve everything for you, but hopefully give you a really good steer in the right direction as to where we can see all those, marginal percentage points gains that can have an outweighted benefit for your practice. So I'm going to talk about a little bit about the business of dentistry and the economics, and then I'll be passing over to my expert colleagues at Christie & Co. We love working with Christie & Co. We know exactly what the product we're going to get from them is, and we know that, no kind of shady backhanded deals or anything like that. We love the fact that they take it to market and get, superior outcomes for our clients. So what I'd like to start with, just want to get a bit of a gauge as to how people are feeling with their practices and their business at this moment in time. If you could please give your little overview as to how you found 2023, and I think that will give us a bit of a steering off point.
Okay, perfect. So you can see some good few answers being submitted. So I'll just give it a couple of minutes for those to come through, and then we can share the results of that. Perfect. Okay, so I'll end that now. It looks like we've got the majority of people responded, and we can see the results.
Thank you, everyone. Okay, so we see there actually a little bit of a spread across the board. We've got 17% best ever year, 54% okay, and we've got sort of 29% who are subpar or terrible. Don't know if there's any kind of more narrative points with number 2 there, Jodie, which will help kind of steer the conversation, but take anything.
Let's have a look.
I think in some sense, I do believe dentistry is at a bit of a point of inflection at this moment in time. It's had so much kind of turmoil over the last 4 years with, a cacophony of really unusual and apparently one-off world events, which have, meant your practice was shut during the kind of pandemic period, open and shut again. And then we've had, boats stuck in Panama Canal, which has messed around with supply chains across the world. We've had bank interest rate increases, which, I know from personal experience of my clients has really kind of caused increasing loan repayments. there's tax optimal ways that should look at for debt structuring later as well, which Simon will go into. But I do believe we've had so much kind of disruption that it would be fair to kind of reflect on 2023 with a little bit of kind of polarity between good and bad. Skip on if that's all right there. We'll add the narrative later. What I think would help put 2023 in context was this excellent kind of macro overview that I managed to find from a government website, which essentially kind of articulates what dentistry has achieved and our personal experience with our client base over the last 15 years or so, which essentially shows spending in dentistry over that time period, which for someone who kind of likes looking at the stats, this is a wonderful thing to see. And what I can convey is that this is excellent performance for an industry over a really long period of time, over 15 years. What we can see is dentistry has essentially kind of doubled in consumer spending over that point in time, which we kind of all know and we all instinctively feel, from certain modalities that practices are now offering to their patients, whether that's even just kind of restorative and elements or facial aesthetics, implants, short-term aligners as well. It's all boomed, and certainly in the private dental sector, it really does articulate it's a thriving and growing profession. And what I want to kind of acknowledge is we have massive disruption in 2020, where you can see it, virtually kind of dropped off a cliff. Took a little bit to recover in 2021, but I think 2021, anecdotally, I would say, reflects that polarity that I think our audience now is seeing. So 2021 was pretty buoyant for the private practices and wholly disruptive for those practices that perhaps weren't positioned to take advantage of the turmoil in the marketplace. Really, really keen to see kind of the evidence of 2022 data, and obviously 2023 when it comes out. But I think it dovetails very much with all of our observations in the industry that we're seeing much more polarity. I think there'll be more businesses that win better. There will be the ones that are struggling, and we'd love to believe that the Hive Group can help them as well. But I think it's something to be really alert of, that there's never any substitute for working on your business as much as possible at this point in time, and as we go through 2024.
Yes.
Hive's role.
Sorry, a bit of a feedback from that poll. Got the results here. A few comments of pertinent points for 2023. So some people said an increase in costs.
Yeah, definitely.
A real mixture of the year, so good and bad, bad associates and staff. Recession, overheads eating into profits.
Yeah.
And labour shortages coupled with tighter financial picture.
Yeah, definitely that. I think it would also be remiss not to talk about the kind of the NHS environment as well, which kind of compounds those cost increases. I'm sure the NHS UDA rate is not going up as quickly as the cost rate, so it's causing this kind of compression point. Where does Hive and our partners in that fit in? There's no kind of perfect way of describing it. We work with our clients in any number of different ways, but one way I like to kind of describe it is what we call the 4 commercial pillars. So in any in any business or any small business sort of less than 10 million turnover, there are broadly 4 commercial pillars that have to be attended to and given thought and developed and iterated. First commercial pillar is the operations or your product. So that's the work you do. That's the dentistry. Now, obviously, you've got to be good at dentistry. We don't help with that a huge amount. It's not what our core competency is. The second commercial pillar is the financial and commercial. And I got a real big focus on this over probably the last 9 to 12 months. I really think dentistry is at this kind of existential point to some degree. Kind of as the poll was suggesting, massive kind of cost compression, but also from the resourcing side of things as well, which the poll showed up as well. It's very difficult in a supply and demand element to try and get the right type of clinicians that will help support and drive your business forward. And of course, what pay rate do you pay them as well? that's worthy probably of a webinar in its own right. So I won't go into that too much. The second commercial pillar, making sure that, the activity that you're carrying out, the dentistry that we're carrying out is profitable. So I kind of describe it as financial and commercial probably needs about 10% of your attention, and it does need that 10%. Can't give it 2% because suddenly that will kind of expand in a hyperinflationary mode and start to kind of take over too much of your world, with cost compressions and cash flow issues, or massive kind of consternation. So I can't underemphasize about how we've got to keep a focus on the financial and commercial element at this point in time. It is quite feasible, and I think it's been inconceivable in dentistry for a long period of time, that a business can be trading sort of 500k revenue or £1 million of revenue or maybe £2 million of revenue and not be profitable at the same point in time. Income is not the same as profit, and we've got this slight rude awakening that's got to be attended to. Third commercial pillar is the sales and marketing. Never has the kind of customer journey been more important than we are at this moment in time. This is a trend that probably started at the end of Q4 in 2023, that I think probably some of the pound notes slightly dried up. We were getting the compound effect of bank interest rates, continuing to be ratcheted up, and consumer spending slowed down. I'll go back to my kind of GDP graph. I still think dentistry is in a massively healthy position, but it's just a little bit more difficult, and it was certainly a little bit more difficult in Q4. So, your customer service journey, your sales, your marketing proposition, all the elements, and quite diverse elements there, really worth looking at. Definitely you're in private practice, but in reality, also if you're in a mixed practice. The fourth commercial pillar is the people in the organization. It's the culture that binds it together. It's a little bit about the brand position again. It's the purpose. It's the mission that your practice has. Having a very clear destination is a really good and healthy thing for all your members of staff, and to attract more clinicians and more resources as well. So Hive helps blend all of that together, and we really do have to kind of blend all those components together. It's our experience you can't really just focus on the dentistry anymore. You've got to pull in these other components of your business to be able to survive and thrive, to grow, to reach critical mass where profit margins are achievable. Don't be too kind of dogmatic about it. I just think it's going to be a real struggle for practices that are turning over sort of 500 or 600k, have enough critical mass to be able to inherently be profitable. I think they're going to be a little bit struggling on any number of fronts. It's our opinion, and we start to see profitable outcomes when turnovers exceeding £1 million, and I really do think every practice can do that as well. Coming back to my illustrative graph, I don't want to use it for everything, but it does show the industry really does have amazing potential, and every practice, in my opinion, should aim to harness that. So I probably want to just drill into a little bit of detail economically, if that's okay, and it's helping kind of articulate why I believe there's this kind of massive inflection point. I think it's this inconceivable notion that dentistry just couldn't be profitable. At its core, the concept I'm trying to articulate really is that income has got to be more than costs. Naturally, I know that's completely obvious, but I do want to kind of display it as much as possible. And building on that is something which I developed called the profit equation. So it's probably being a little bit more specific and a little bit more helpful, I suppose, than my rather flippant income has got to be more than cost, because this is how dentistry makes money, or how it doesn't, as the case may be. So if there's only one thing to take away, I would really love you to kind of take away this and to ruminate on it, and ask us by all means as to how we can make it better. But profit in dentistry is a function of three things, thankfully only three things. So the first one is income that's coming in the front door. But I want to be a bit more specific than that. We at Hive really like to look at it on a kind of daily basis. I think it's a little bit more practical. It's a little bit easier to measure. But if we can see on average how much income you're bringing in on a daily basis, or how much each clinician is bringing in on a daily basis, this is almost like the key to the kingdom. The second part of the equation is how much are you paying that clinician for the income they generated? If you read our blogs, if you don't, you can happily find them in the archive. We don't believe that 50% has much longevity anymore. And I'll illustrate why in a moment with some, pretty defining maths. But, thankfully, the industry does have a pretty decent framework for how you pay the clinician, so we can start to blend it together in terms of this equation quite quickly. The third component is how much does it cost you to open each surgery, what that singular surgery where that clinician is carrying out activity, how much does it cost to open that surgery on a daily basis? And I like looking at it per surgery. I don't like looking at it as a practice because we really want to get specific on performance. But the really interesting thing about this is we've done this maths now probably for the past 3 or 4 years. And when we first started doing it, we found something that was really, really interesting. Is if we add up all the running costs of a practice, we ignore how much we're paying the clinician because that's dealt elsewhere in the equation. If we add up all the other running costs and normalize them, so we won't factor in bank debt repayment, for example, because different people's bank debt can be different. But all the other kind of usual running costs that every other single practice operates, we add those all together, we divide it by the number of surgeries, we get back to this overhead cost per day. Now, the really interesting thing we found was that you could be a large surgery in Scotland, 6 surgery site in Scotland. You could be a 2 surgery site in Norfolk, 2 surgery site in Cornwall. What we tended to find, the West End of London only being the slight anomaly, but we tended to find that that number would come back to about £550 a day, spooky amount of the time. So the fact that it kind of kept occurring was hugely kind of interesting to us. We kept on doing the maths, and it just keeps on coming back to about £550 a day for a private practice. A bit less than an NHS practice, probably about £450 a day. But it actually told us something quite quickly as to the economics of dentistry. So if I apply a bit of numbers to that, I think it will just kind of come to life. So what we have here now, and I'll numbers from the top down, we tend to see that the average private practice associate, and it does vary a bit, admittedly, but the average private practice associate will bring in, on average, £1,300 a day. So that might be, for example, £13,000 a month, and they've worked 10 days that month. That's £1,300 a day. We like to look at it on a monthly basis. And again, if I can only give you one kind of tip to take away, do this maths for every single clinician in the practice, including, yourself as the owner, as the case may be. We want to see what revenue was brought in, how many days did you work. Now we want to take a lab cost off of that. Varies for different people. Some people do a huge amount of Invisalign, for example. Some people don't, and it's just general maintenance dentistry. It's absolutely fine. We want to take off the lab cost. We then want to pay the clinician. I've used 45% of my maths here. We then have that overhead cost that I'm talking about, £550 a day. Each practice will have its own specific one, but in the absence of any numbers, it's pretty reasonable for me to guess 550. You can see what we've got as an end result. It's £100 profit. So it probably kind of articulates, because I can't ask the audience in a poll as such, but I think every single time I've asked someone, how does that feel? They said £100 doesn't feel that great. And I'd agree, it's way less than 10% profit on the activity. It is fairly average. What I kind of articulate is that's a pretty average position, but what's happened since we started collecting all this data from about 5 years ago is, of course, the goalposts have moved. We've had increasing energy prices. Just to say the least, we've had increasing lab costs where, we hear repeatedly. We've definitely had increasing staff costs. That £550 overhead cost is no longer £550. It's now £600. So, of course, you can see exactly what happens straight away is that £50 excess just falls off the line. We've now got 50 quid of profit. Of course, if it's a little bit more in running cost, there's no profit at all. Or if you're not, if the clinician's only bringing in £1,200 a day, there's no profit at all. Now, I think this is a manifestation of exactly what's happening to practices at this moment in time. So I would wholly recommend you run your own maths, call in, ask us to do so. But either way, in my opinion, you need to know this maths. It will, it's not going to may not give you good news. It might give you good news that you're showing that your performance of your clinicians is profitable. But if there's bad news, I always say it's better that you find it out as quickly as possible. So the ADY, this is the average daily yield, is that £1,300 metric. It's if we only could choose one metric to view in a practice, we'd choose the ADY. Just going to give you very quickly the other metrics that we think a thriving and growing practice should be tracking. So number one, the ADY. Number two, we think you should be diligently tracking the number of new patient inquiries that you've got. Not too complicated there. Every practice should be tracking its inbound leads. It's going to tell you a few things. It's going to tell you which of your marketing channels are working and not working. It's going to tell you if you've got a good reputation in the marketplace as well. There's so much kind of depth in there. Number three, the average new patient value. We want to understand of those new patients that are coming in, what are they buying? How much are they buying from you? It tells you a lot about your treatment planning proposals. It tells us a lot about your communication and your new patient journey, or your full customer journey. We want to look at conversions as well. So that's conversion from someone inquiring with you, converting to them attending the practice, having a consultation. We also want to see the conversion rate from consultation to accepting treatment. Again, it's going to tell you different things. It's going to tell you if you've got a miserable receptionist. It's going to tell you if you've got excellent communication skills at the clinical and treatment planning phase, or vice versa, or both of them. Number five, of course, we absolutely believe you should be tracking your profitability. Again, we want to, going back to the commercial pillars, if it's just 10% of your time, effort, and attention, that's fine. You're going to need to know it. So dovetail it together with the the ADY that we were talking about earlier.
Hi, Russ. We've just had a question in actually. Are there any common software which can help track these KPIs?
I'd say for profitability, very straightforward answer. The market leader seems to be Xero. It's cloud-based bookkeeping. Don't complicate it, just use it. It absolutely should be should be in place for every single business in the land, let alone every dental practice. But it'll either save you time or money, or both, in my opinion. In terms of tracking kind of a lot of the other metrics there, new patient activity, it definitely divides opinion. We tend to see that a bit of software called Dengro is about the market leader for lead management, which is what we're talking about there. It's less about the software, as they kind of say, you only get out, data in, data out, isn't it? So in my opinion, it's actually more about your motivation. If you tend to find that it's important to you, and I believe it should be important in a practice, then hell, you can write it down on a bit of paper as far as I'm concerned. But as long as you're tracking it and using it and making decisions on it, I'd be fine with that. But yeah, some practices will track it on Excel. That's absolutely fine. Some practices will track it on Dengro, which is the one we tend to recommend. But we also see practices that have Dengro and the reception don't write down the leads. Of course, it's all useless then anyway. But then we do see other practices who'll be tracking on Excel and they're diligently recording it, and that's absolutely fine. So software is never going to solve the problem for you. If you as a practice owner are motivated to improve your business, where there's a will, there's a way. Thanks, Jodie.
Thank you.
What I want to skip on to, again, probably just add a little bit more depth to the profitability. I'm not going to go too far into the marketing side of things this evening, but want to kind of really help kind of focus on profitability as well, because it's also one of the most crucial things when you're coming to sell your practice as well. And it was a bit of an irony as well. We've been trying to talk to our clients for probably almost 2 decades and say you should track your profitability a bit better. But what tended to happen is they kind of didn't mind too much, whilst the whilst there was hay, the cash and the profit was okay. The drawings would support their lifestyle, but kind of true profit measurement only really seemed to happen prior to when they were coming up to a sale event. And of course, there's, depending on how late you leave it, you can't really optimize it too quickly. So profit measurement has never been so important, and it's becoming much more kind of prevalent. Zero bookkeeping is making things a whole load easier as well. We just thoroughly recommend it. But I want to take that information, which is, it's amazing, rich source of information. And we run an exercise essentially where we help practices benchmark against the marketplace and identify where they might be doing better or worse, as the case may be, and look for all those percentage point improvements. Again, I could definitely do a whole webinar on kind of profit assessment, but what I want to showcase is one little tool that we work with our clients on, just to help kind of visualize and help guide very quickly and very easily where, to indicate how practices are doing and where they might want to look a bit better. So the first thing, as I'm going to show you in a moment, is the tool that we use that captures the data, and it's just a presentation component. But what is so beautiful about it is it enables us to compare against the marketplace. It's a pie chart, but the great thing about it is that we're taking out of financial accounts, which can be long, boring, pretty intense documents, 14, 15, 18 pages if you've got a limited company. We're just taking out the relevant parts and harmonizing them in a standardized way for dentistry, and showing what we've got as the outcome in front of you there. So each of those components of the pie that you can see in front of you are standardized for, a standard across pretty much every dental practice in the land. Every dental practice in the land has lab fees, materials and waste costs. I'll come back to the grey segment in a moment, but it has associate costs, it has hygienist costs, it has wages, so that's the nurses and the reception team, it has premises costs. You get the gist. This is the way of really visually and very easily benchmarking against your competitors and helping guide as to what the outcome will be. I think the thing I'd point out there, probably two things actually I'll point out. When we're looking at profitability, we've got to be mindful that the owner quite often works in the business. The owner is quite often the highest performer in the business. Now, when we're looking at true profitability, certainly when we're looking to appraise for sale, we've got to acknowledge that. We've got to acknowledge that no one will work for free post-sale. That's the general kind of theme. So, in a post-sale environment, the owner, if they want to carry on treating dentistry, they'll need to be paid. So it's most important that you add in a cost or a salary for the owner if they don't take one. So we want to, kind of normalize that. And what you can see is an outcome there. So this is a pretty kind of standard practice that we've taken, which is about 700K, about 750K revenue. And the outcome, as you will see, is a 4% profit margin. Now, there's so much variation when we see these profits. Market leading practices will be, probably 25% profit plus. We've seen them with negative profit, which is, really troublesome, but we have seen them. The average level of profit in a private practice in the UK is about 3 to 5%. NHS practices can vary even more wildly because most of the time it's, quite dependent on what the UDA rate, also how much you're paying your clinician from it. I'm starting to hear horror stories about people having to pay £20 a UDA to their clinician. And again, there's a bit of a polarization. It seems to be resources available in London, but anything kind of outside the M25, we're hearing that it's really quite difficult to resource them. £13.50, £15 a UDA. Like I say, worst case horror story, £20 a UDA. No point opening the door. So yeah, very mindful. I'm only kind of, we're really only scratching the surface with this. But again, I wholly recommend that you get your bookkeeping on the cloud, and then we can start looking at profitability together and really start focusing in on what you want the outcome to be, where the profit improvements can be made. It's more cash in your pocket at the end of the day if you help optimize this. it will also give you a higher exit price as well. So kind of starts 6 months prior to exit. You really want to do this 3-4 years prior, ideally.
Thanks, Ross. We've had someone, and you've almost answered it, but someone has said, are these percentages targets?
These ones aren't, no, because I don't want anyone to target 4% profit outcome. I don't think that is deserving of the many years of training that you've gone through in dental school, and probably the many years of blood, sweat, and tears you put into practice. What I'm displaying here is actually the average practice. So if I turn it around, this is an amazing opportunity again. If the average practice is outputting 4% profit, we know there'll be, probably about 47 different different levers that we can pull, each of them giving you little kind of percentage point increases. We want to get you to 15, 20, maybe even 25%, but depends on circumstances. But yeah, please don't take this as a target. In fact, I could point to each of them and say they're all probably 1 or 2% more than they should be. But when we're working with a client, we give you reasons why. We really kind of zooming in. An exercise we run with a practice is something which we call a diagnostic. So it's a full in-depth analysis which helps zoom in and kind of picks apart, tries to understand exactly where you are. So that might be relevant to some people.
Thanks, Ross. Just got a couple more questions. So one of them is profit after interest payments on debt.
No. So I'm sure Jonathan and Jamie will talk about it later. No, so it's the one thing that kind of doesn't exist within that pie. Some people might have bought their practice with cash. Some people will have bank funding, which we totally acknowledge. But when you're looking to appraise it for sale, or even when you're looking to appraise it, how well are you? And I can't include that interest because it might be different in different practices. We can't benchmark it. It would be unfair to benchmark it. So kind of a very good point in some way that, quite often what we'll do is, we used to have this, many years ago, that you'd get people sort of buying into their practice, and about 12 or 18 months later, they call us up and say, I'm drowning here. You say, okay, great. What's going on? And their performance of their practice might be something because they got bank debt to repay out that profit, and £26,000 of profit there doesn't support much of a bank loan, unfortunately. So I think there's often a preconception that a dental practice, you buy a dental practice and it's the golden goose. But I think it's a labor of love you often have to work at, but you have to be working at it, and you can't spend all your time on the dentistry component. We have to look at those other commercial pillars that I was talking about earlier.
Another person has put, I thought EBITDA, not profit, is the most important metric for a sale.
Yeah, EBITDA. So EBITDA is essentially this profit segment here, interchangeable components. EBITDA, the spirit of what EBITDA is trying to convey is normalizing profit in a practice. So the previous comment about interest is probably a pretty good one. So there'll be interest in your financial accounts, but when we compare you against another practice, we're going to take out all those anomalies, one of which is the interest, and interest is the I in EBITDA. So what EBITDA is trying to convey to you is we're going to normalize your practice so that we can compare it against that. So earnings, i.e. profit, earnings before interest, depreciation, tax, and amortization. So this is taking all the weird things out of your accounts, including interest.
Perfect. Just one last one. Does this average include NHS only practices?
I tend not to kind of include them, but if we were to look at averages of NHS, it's almost a little bit more difficult for me to give you an average, unfortunately, because it can vary so wildly. We know NHS practices that are losing money hand over fist. We know ones that are making good amount of money, and it's all down to the UDA rate and how much the clinicians are paying their how much the UDA rate they're paying their clinicians. So when we see them, when we see NHS practices work, they can work really quite well. Because we've had this inflection point in 2023 where kind of no one wants to work in an NHS practice other than central London. And I'm being, hugely generalizing there. But we have tended to find that it's really difficult to recruit NHS associates outside of London, like really difficult. If you've got one, brilliant. But what if you can't get one? What do you do? We've got a massive signpost that Bupa sold about 20% of their portfolio. Remember that was Jamie Jonathan might kind of chip in, but I think it was within the last 12 months. And they were all practices that the ones that I looked at, they were all practices that essentially couldn't resources to fulfill their NHS contract. So I believe there's still profit in NHS practices, but unless you as an owner, you're doing the whole contract yourself. I just question the more medium-term strategy. Might be great, but what are you going to do when you need the next clinician? We're just not finding that people are attracted to NHS practices as much as they are anymore, unfortunately. And welcome. It won't apply to everyone, but I'd say probably 8 out of 10 practices that we're speaking to are struggling for finding resource to fulfill their NHS contract, because the clinicians can kind of just go down the road and work for the private practice and get 45% of it, and the pricing's different, unfortunately.
And just because it's really specific to this pie chart, I'll do this one as the last question. Which element of this pie chart is easier to reduce or get under control to maximize profit?
Which segment is the easiest?
Yeah.
Oh, crikey. I would say, well, in this particular pie chart, I would probably pick at the premises costs and say, do you know what? That's probably double what it should be. So that's telling it's a big old expensive site which is under capacity. So if we grow revenue through that business, then that part, and that grey segment will automatically shrink. And a dental practice should have premises costs less than 5%, in my opinion. I'd look at the wages sorry.
So essentially what you're saying is there's not one answer to that. It's very specific to the pie chart that's created for a practice. You'll analyze that specific to that practice to be able to.
It does depend. There's because this is the average 4% to 14%, so there's 10 percentage points that we want to win everywhere. So we're going to kind of attack everything, but each one will have a slightly different kind of. So materials and waste is too high in that, for example. The wage cost there is too high as well. We don't know what's going on there. It might be that this practice was, again, it's under capacity, and therefore there's less activity, so there's kind of more staff than you need. So it is quite case specific, unfortunately, but got the analysis for each practice. The kind of the roadmap for each one is usually kind of straightforward in complexity. I'm not saying it's easy to solve, but the precise kind of prescription for each practice usually comes pretty clear to us once we've looked at it. Cracking, thank you. So yeah, EBITDA. I've just kind of simplified it by using the word profit, but the profit that we want to look at is important and really exciting as well to us. So this kind of blend together with how your practice is worth. And again, I don't think this will be kind of too complicated, but I'm trying to provide it with some emphasis, I suppose. So actually, I've got a couple of questions. I've got a couple of extra questions from the previous one, which I might just kind of cover off now. There's a couple of people asking a similar one. Is the marketing low? I would say, let me skip back. I can share it again. So there we go. There we go. 1%. Yeah, really low. Yeah, they are spending something, which is good. But again, it depends what this practice is doing. It might be a large plan practice and not really required to grow. But generally speaking, if you want to be growing in this marketplace, you do need to be spending more than 1%. You definitely need to be spending more than 5,800 quid. It indicates that you're probably not doing much for internal marketing as well, stimulating word of mouth referrals, etc., etc. So, yeah. I'd say it's low. How you would deploy that budget, though, again, quite case specific. But if you're only spending 1%, you're going to be not going to be thriving or growing, or if you are, it's going to be all down to your kind of labour hours and your input. We would normally say do that, but kind of do marketing as well. Why wouldn't you do both? So yeah, probably just to emphasize how we get to value. Like I said, reasonably obvious, but it is worth kind of stressing. So what we're looking at is the profitability of a practice. You know, what we're trying to indicate, the little icon, is the profit is your responsibility. You can never abdicate it. It's your business. And I don't go blaming anyone else. You know, as I was saying earlier, if there's bad news, I always think it's better if we find that bad news out as quickly as possible so we can start to work on it. And I do believe we can work on it in dentistry. I'm emphasizing the actual profit. You know, unfortunately, too many times when we're looking to kind of appraise a practice and we're getting crappy old reports printed off from Exact, which is that lovely software system I think, you know, significant proportion of practices seem to use. But what we want is really robust data. We recommend Xero. You don't have to use Xero. Other cloud-based bookkeepings are available and you're welcome to use them. But the point is you do have to use them so you can evidence what the actual profit is. The buyer will feel really warm and comfortable inside if they can interrogate your data. It becomes kind of a non-issue. We estimate just kind of having that reliable data might be worth maybe 5% extra on your exit value. Again, just because you can evidence what you've got and there's no problems, there's no negotiation, there's no debate. They just see what they're going to get, and like they feel really good and comfortable inside. So we're looking at your profit. We're then looking at the multiple you achieve, and that gets you to kind of the value. So this isn't mathematical, but it's the kind of foundational elements of what you do need to do so that that value gets bigger. And when we're looking for kind of maximum multiple, we turn to our colleagues at Christie & Co, and it is their job to get you the maximum multiple. So you've got to run your business and optimize the profit. Fairly straightforward. Make sure you're tracking your profit on Xero. And then when you're coming to exit, we're looking to maximize your multiple. And blend those two parts together. Best outcome for you in terms of value and terms of the deal as well. So I will happily wrap up now and hand over to Jonathan and Jamie, unless we've got any straggler questions there. I'm more than happy to field them.
We do have a couple that we can whiz through now. With reference to these figures, do you think the days of being a practice owner is over? Might be financially better off as an associate?
I would say I think it's an excellent time to be a business owner in dentistry, but I'm very specific about my answer there. I think it's a brilliant time to be a business owner who happens to be in dentistry. If you just love your clinical stuff, there's absolutely no problem with that. It's a really well paid profession for being for being an associate dentist. I think you just got to be consciously choosing your poison. Makes sense. I've got another question actually. I got some people saying thank you. Really nice. Someone's asked, do you think the profession is kind of evolving to fully private? And I'll maybe dodge the question a little bit, but I think what I'd say is that I think everyone kind of knows it's going there anyway. We're just debating the pace at which we're going there. We know we don't have any funding. You know, from a macroeconomic point of view, we know there's less and less funding being available. I personally think there'll be some kind of emergency access thing. I think a lot of people share those views, but I wouldn't, you know, if I've got a medium to long-term view with my practice, I wouldn't want to be staying in NHS. It's just risky at every particular, you know, orthodontic practices have been barreled around a huge amount of time, not knowing where they stand. So if you want control over your own destiny, I think it has to be private. And I'm not because I'm against NHS. I just think if you want to have control over your own business, private practice is where you have control and market opportunity. Got a bit of question about multiples of value, but I'm going to defer that and hand over to Jonathan and Jamie. Also, how long will it take to sell a practice? I'm going to hand over to them if that's okay. Those are very much questions for them, if that's all right.
Good evening, everyone. I'm just going to share my screen. Just let me know that you see that okay.
Lovely. Well done, Jonathan.
Brilliant. Okay, welcome everyone. Good evening. I'll be discussing the practice sales market along with my colleague Jamie and sharing some key insights on things to consider when selling a dental practice. Okay, so for those who don't know Christie & Co, hopefully you have by now, but those who don't, Christie & Co, we are agents and valuers specialising in the sale of dental practices. So our team of specialists operates across a network of 11 offices across the UK, offering a single point of contact throughout the sale process. And importantly, it's someone who's based in the region, based in your region, knows it well, knows the best buyers and perhaps those buyers to avoid. We work exclusively for the seller, meaning there's no conflicts of interest with buyers paying agent fees. Quite often we'll see our competitors offering to sell a practice for free, which sounds great, but they'll be taking their fee from the buyer. So, I mean, aside from the clear conflict point there, they'll only be approaching really small parts of the market who are willing to pay a buyer's fee, often ending up with a mediocre offer and associated terms. So the only way to make sure you receive the best result in the market is by appointing an agent to approach everyone. And notably, we're the only RICS accredited firm handling practice sales, which underscores our commitment to maintain the highest professional standards in our work. I think the other thing to mention about the RICS side is, aside from our sales and brokerage side, we have a team of chartered surveyors, which you can see there, and they'll offer things like formal valuations for loan purposes, refinance. They'll also help with things like rent reviews, freehold investments, and sort of partner buyouts and mergers and things like that. So there's a range of professional services as well as our core sales business. Okay, so this slide provides a breakdown of dental practice ownership, in England and Wales. And I think there's a perception that the corporates dominate the market, but if you look at the smaller pink, purple bar chart there, it reveals they only comprise around 17.5% of the market. Notably, My Dentist and Bupa are the leaders in terms of practice numbers. Closely followed now by Portman and Dentex, who I'll speak about in a moment, sort of hot on their heels. Beyond the corporates, we've identified around 800 group operators representing about 2,500 practices. You can see that the blue bar chart there. And additionally, nearly 8,000 single-handed practice owners contributing to the diversity of the market. So it's essential to remember with this vibrant independent sector, and that's not going to change anytime soon. So the big question, where is the dental market right now? So I would say that the current state of the market is marked by strong demand across all practice types. And despite a relative increase in practice listings, the available opportunities still fall short of meeting buyer demand. And that means that when we launch a practice to the market, we're still getting sort of multiple viewings and offers for each practice we launch. A notable trend is the surge in first-time buyer activity, particularly from associates seeking to secure a future income by acquiring their first practice. Lenders who were initially cautious during the pandemic have renewed their appetite for supporting such ventures, and we're even seeing a number of challenger banks come into the high street. Independent operators have outpaced some of the corporates in recent years, with regional groups strategically expanding their portfolios, that's often backed by family money. In the past year, as I mentioned briefly, there's been some high-profile mergers such as Portman and Dentex coming together, Roderick's and Dental Partners, and even the acquisition of the Hanji Group by Riverdale. And that's sort of reshaped the landscape. Some corporate groups are now focusing on integration and organic growth. And one example of that is one of these sort of corporate disposal programs We're delighted to handle the sale of 44 Bupa practices, which I think Ross touched on earlier. And we've seen great success in that area with deals agreed for all 44 of those practices, many of which have now exchanged and completed. And it's important to say, talking about that landscape earlier, that the majority of these were sold to independent operators, first-time buyers, and even some of the current practice associates in those practices. So it's been a real sort of important churn for the independent market. So, well, that said, the corporates are still active. There is still a corporate market, but they're being perhaps more selective, targeting locations that are perhaps easier to recruit to, practices of higher quality, often opting for practices with sort of full UDA allocation on the NHS side, and often sort of private clinics and specialist income has been their real focus in recent years. But additionally, there's been a notable entry of existing groups from the US and Germany, which has been an interesting change in the market. So despite challenges in the NHS affecting the delivery of dentistry, private revenue has seen real rapid growth, even surpassing pre-pandemic levels in many cases, or perhaps even most cases. Something obviously that Hive worked closely with in growing private revenue. But we're seeing this across the board. And there's an optimism that this surge in private growth can be sustained long term. It's not we don't see it as a short-term sort of bubble, if you like, as a reaction to the patients not being seen on the NHS, those access issues. We see changes in patient demands and think it will be there in the long run. And finally, sort of recruitment challenges, especially in the NHS, as I mentioned briefly, have been acknowledged as a hindrance to the market. There's anticipation for measures of reform to address the shortage of clinicians and nurses in the coming months. And one thing we're sort of hearing of, and I'm sure you have as well, is a streamlining of the PVLE routes and overseas registrations to provide short-term relief for NHS providers. So this chart shows the type of buyers for Christie & Co. transactions in 2023. And it's a good mix of corporates and independent buyers. You see that we've gone for a pie chart as well, Ross, and you can see a real sort of mix of different groups of people purchasing practices. And with 69% of all transactions agreed to first-time buyers, existing operators and small independent groups, mostly backed by high street lenders. So as the year progresses, we expect more corporate buyers to rejoin the market, leading to perhaps an even more varied mix, potentially fewer sales to independent markets, as we've seen real sort of independent dominance in the last couple of years. So what are buyers looking for? Well, I guess it's a similar story. It is a varied picture, but just to illustrate here the preference of buyers, the first bar here, I appreciate there's a lot of data there, but the first bar here represents independent interest. The second depicts the interest of small groups, and the third is corporate activity. For the data is from 2022 and 2023. And really demonstrating a diverse range of practice types that buyers were interested in. Many showing a preference for mixed income practices, perhaps suggesting a strategy of spreading the risk across both NHS and private sectors. But that said, demand for sole NHS practices, listening to what Ross was saying there as well, the demand for NHS practices has reduced, reflecting concerns within the sector on the delivery of NHS contracts and the sustainability of the current model. I would caveat that there's a bit of a two-tiered market there, where we're seeing a lot of corporates, most corporates pull back from the NHS in terms of acquisitions. For those sort of smaller NHS practices where an owner can come and deliver the bulk of the income on their own, we are still seeing really strong demand that I mentioned earlier. So a bit of a two-tiered market depending on the size and the ease of delivering it, which all links into the recruitment challenges we're seeing. I'm now going to pass on to Jamie, who's going to chat through our practice sales activity and some tips for sellers considering an exit. Shall I, do you want me to progress the slides, Jen?
Yeah, thanks, John. Thanks all. Yeah, so I'm just going to give us a brief update on some of our activity in 2023 and a few top tips for when selling a dental practice. So in 2023, our specialist consultancy, professional and brokerage teams advised on, valued or sold 908 dental practices with an aggregate value of £750 million. The Christie & Co dental team launched 195 new practices to the market, facilitated 797 viewings, received approximately 600 offers, totaling over 310 million in value, formally accepted 138 offers, and successfully exchanged and completed on 113 practice sales. In 2023, offers were on average 113% of the asking price, up from 102% in 2022. The number of offers went up by 80%, reaching around 600, and on average, each sale had 4.4 offers. So pricing trends. There are two main ways to value a dental practice: owner-operator or associate-led. With owner-operator, principal-driven practices, these practices involve a working principal who directly generates revenue and takes personal drawings. The cost of the income generated by the principal is not fully accounted for, resulting in a higher EBITDA percentage and a lower valuation multiple. With associate-led practices, there is either no dominant principal or the practice has a full team of associates in place. The dental income is fully costed, leading to a lower EBITDA percentage and a higher multiple on earnings for valuation. Multiples are ranging dramatically depending on size, location, income mix, and performance. The market trends show that larger private and mixed practices are now achieving higher values compared to NHS-focused practices. This indicates a growing preference for practices with a significant private or mixed income stream, reflecting their perceived stability and growth potential.
Hi, Jamie. I think we've just got a question that's probably quite suitable to ask at this time. So is there a rule of thumb for valuation? Instead of using a multiple, for example, for NHS contract value is usually 1.1 or 1.2 times, and private work is around 1.5 times. Is that true?
I think historically in the market, there have been ways of valuing like that, whereby percentages of revenue are used, or NHS contracts, percentages and multiples. But generally speaking, banks and as agents, we tend to work on a multiple of EBITDA. I think you can use these percentages of revenue or multipliers as maybe a sense check when comparing that to your multiples of EBITDA, but generally the market's moved on from doing that and tends to now focus on a multiple shown on this slide within that range on the EBITDA figure.
I think I'd just add there, Jamie, I think we see a vast range of percentage of turnovers, don't we, paid. I mean, we could see, for instance, an NHS practice with a gross UDA rate of £27, and they're having to pay the associates £15 to deliver the work, and obviously that margin is then tiny when you sort of work in all Ross's costs that they mentioned before. If you've got a gross UDA rate up at £40, you're only having to pay them at £12 net. On the NHS, you've obviously got a huge margin there to play with. So how could you value those two businesses on a percentage of revenue? It can sort of it's all about finding that bottom line, whether that's a daily yield or EBITDA, and sort of looking at that profit and multiples of that then.
Wonderful, thank you.
Okay, so here's a couple of recent successes that we're happy to share with you. We're delighted to announce our involvement in facilitating one of the most noteworthy independent dental business transactions in the UK. This collaboration brings together Queensway Group, a prominent dental force in the Northeast, and Dentex, a renowned dental corporate. Additionally, we successfully managed the sale of Hornby Group, comprising 3 predominantly private practices situated in and around Shrewsbury. Despite the challenges posed by volatile trading conditions in the first half of 2023, we received multiple offers surpassing the guide price and adeptly steered the transaction to a successful conclusion. So a few top tips for sellers: initiate the process, consult an RICS regulated agent early for advice on market conditions and potential buyers, choose an agent carefully, avoiding those offering free services with potential conflicts of interest, understand your sale, know the variations in deal structure, including payment terms and post-sale obligations, seek professional advice to negotiate offers and navigate post-sale conditions, assemble your team, build a team of experts, including solicitors, accountants, and brokers to guide you through the process. Inform your accountant early to ensure sound advice on the sale structure. Prepare for due diligence. Collect necessary documents in advance to streamline the due diligence process. Collaborate with staff or practice managers for efficient document gathering. And finally, stay motivated. Acknowledge that selling takes time, but can be managed with planning and professional assistance. Address challenges as they arise and rely on your expert team for guidance.
Thanks, Jamie. We've had someone that's asked, what does the RICS regs mean?
So effectively, that is the Royal Institution of Chartered Surveyors. So we adhere to the standards regulated by that institution. So as a dentist has certain standards to adhere to, we're the same, and we have a set of professional standards and guidelines that as a company we have to follow, and that means that you can trust in our advice, know that we have to behave and operate to a certain level, and yeah, it can give you confidence effectively in the way that we would act for you as an agent.
Perfect, thank you. We've got a few additional questions, but I think they might be maybe good to run through at the end. We want to you might cover it off. So
yeah, I think the next slide is welcoming questions. So yeah, let's fire away.
Perfect. Okay then. So starting from the top then. So how long do you think it would take to sell a practice?
So I mean, it does vary. You know, typically last year we were seeing transactions take anything from 6 to 12 months. I think the average deal time worked out around 9 months. So it depends on the type of practice being sold, the structure of the deal, the motivation levels of both buyer and seller. But I think it's probably reasonable to have a time frame of somewhere between 6 to 12 months in your mind if you're thinking that you're wanting to sell your practice.
Perfect. Does value increase more when freehold is included?
You want me to tell that, Jamie? I think just to clarify, all those multiples before that we mentioned, those multiples of EBITDA exclude the freehold interest. So they are multiples of EBITDA, which gives you your price for the goodwill equipment, so inclusive of equipment, fixtures and fittings, but exclude the freehold. Obviously, we sell a lot of leasehold businesses. We sell businesses to corporates who tend to solely purchase the business, the goodwill. And so the freehold is always, for the purposes of our data, is always excluded. So yes, we can of course sell the freehold in addition, but it's always calculated separately. We tend to, from our backgrounds, having the RICS background, so having surveyors, chartered surveyors working with us, we obviously understand property better than our competitors, and we'll give people a steer as to what the property may be worth in the market. And then it'll typically be subject to evaluation, which the buyer will generally appoint a bank. The bank will appoint an independent chartered surveyor separate from us if we're handling the sale, that will sort of come forward of a formal valuation of that property, but always excluded from the business side.
Thank you, Jonathan. What are the fees associated with selling a practice through Christie's?
Well, I think we are competitive in line with our, you know, with the market. So it's a percentage of what we achieve for the practice. obviously we deal with everything from a £50,000 single chair practice up to some of the largest transactions in the country in recent years. And Jamie mentioned a couple of those on the previous slide. And obviously we'll be competitive where we can and sort of structure our fees to the job, which I'm sure is very similar to Hive.
Thank you. Would it be better to sell the business and the property together? I own the building of my practice. I own the building my practice is into.
I think it depends entirely on you as a seller. You know, there's appetite in the market for freehold properties. Similarly, there's appetite for just the leasehold, and people don't want to take on the property. As a seller, it'd be worth considering what the sort of tax implications are for you to sell that property, or whether it would be more beneficial for you to become a landlord, create a new lease on it, and then take the rental income each year and potentially sell it as an investment at a later date. So it's really down to the preference of the seller. Taking advice from their professional team, and also considering what it would mean. Maybe some people don't want to become landlords; they've got no interest in doing that, so therefore they would want to sell the property. I mean, we can help with either way, and as I mentioned, there's appetite for both types in the market.
I'd probably just also kind of chip in there as well, kind of massive tax implications, like both ways as well. If you're selling your freehold as part of it, you might go down one channel. You don't want your freehold as part of it. Often, Simon spends a lot of time kind of unpicking structures that are, perhaps kind of weaved together and undesirable in a sale. So again, kind of just emphasises the start planning early.
Yeah. So someone has 5 practices. Will I get more value if I sell under a group structure or piecemeal?
It's a really interesting question. And I think if you'd asked us 2 or 3 years ago, we'd have said absolutely, you will get a lot more for your group. It really depends on the business mix. I mentioned, I mentioned earlier there being less buyers in the market in terms of the corporates for NHS practices. So if you had 5 NHS practices, you might actually find that right now we've got fantastic demand from independents, that actually doing a sort of a breakup sale is actually going to get the better result right now. If you've got a group of 5 large private practices, then there's going to be 10 to 15 groups and corporates absolutely wanting that group. So it really depends on the business mix, and we'll sort of tailor our advice to that.
Just to add to John's point there, I'd also say that we can, if that's something that you wanted to explore, we can present it to the market in both ways. So it can be offered as a group or as the option for it to be broken up and sold individually. So in doing that, we would test the market and we would be able to present to you the best possible offers.
Wonderful. Do all agents need to be RICS regulated?
No, they don't. Oops, go on, John.
Sorry, I was just going to say, a state agency doesn't have a regulative body, if you like. Because we offer formal valuations, we have to have that. As I mentioned, we are agents, Jamie and I. We have chartered surveyors as well that sit with us. And as I say, when a buyer goes to get that loan, the bank will instruct a formal valuation. To be on those bank panels, you need to have the RICS regulations. So we as a company do both. But what it does provide, as Jamie said, is the knowledge that we have to adhere to those strict rules and regulations. One of those being that we can't be seen to be taking buyer fees and professing to work for the seller. We have to be clear from a conflicts point of view who we're working for, and that is the seller. So I think that's the clear thing to say about it.
Yeah.
And worth noting also, Jodie, that we are the only RICS accredited firm operating in the dental space.
Perfect. Okay. There are a couple more questions, but we do have Simon's section to run through. So I think if we move on to Simon, and then we can, if we've got time at the end, We can come back to the questions. If we don't get time on the webinar live, we'll make sure that the answers get responded to, sort of typed through. I'm not sure if Jonathan and Jamie, you want to type any answers that are specific for you, but I'll leave that to you. But thank you very much. That was great. So yeah, so Simon is now going to talk through tax strategy.
Thank you, Jodie. Thanks, Jonathan. Jamie, always very interesting to hear how the market develops and the activity that Christie and Co have seen over the last year. I'm going to talk a little bit about what we call tax strategy. Probably start with a bit of an explanation of what we mean by that, because I think to a lot of people that might be an unknown kind of term. You know, in the UK, we have a tax system based on self-assessment, but we have a tax system that is ostensibly designed to tell you to pay the right amount of tax. But actually, I believe you've got a lot of control over what your own tax should be. And that's kind of what we mean by tax strategy. It's taking control of your own tax. Yeah, how do we do that? What does it mean? How do we deploy a tax strategy for you? I think there's three key components to making sure you've got a tax strategy that works for you, making sure your tax isn't any more than it needs to be. Three key parts to that, really. Firstly, zero. Zero has been mentioned a lot. Doesn't have to be zero, but having up-to-date numbers of how your business is running. It kind of just helps with how you run your business. You know, if you're concentrating solely on last year's financial accounts, you know, they could be 9 months old before you even see them if you haven't got a very good accountant. Really difficult to run your business, impossible to plan your taxes from that. We focus a lot here at Hive on having up-to-date numbers for our clients, kind of what the middle icon symbolizes as well, having up-to-date information. So having the data is important, having it up-to-date is equally as important, so we can help advise you on how you are performing in the current year, what that might mean for your taxes in the current year, and possibly even into the next year if we can see some trends. Helps us advise you on what opportunities you've got, what options are available to you to minimize those taxes. Big thing we look at as well is actually dividends for limited companies. We'll come on a bit more to limited companies soon, because that's another key component to having a tax strategy. The third key part, communication. There's very little as accountants we can do if you don't engage with us. If you're not talking with us, there's very little we can do if you tell us 9 months later what you did do, rather than telling us or asking us what you're thinking of doing next month. If we're in that kind of constant communication, if we've got up-to-date data that we can actually look at, then you and I can have some really good conversations about what your taxes might be and what options you might have to mitigate them and to keep them as low as possible. Everybody's circumstances are different. The results that can be achieved for everybody will be different, but this kind of gives us the baseline to setting that plan, which I think is kind of vital to not just falling into the system and paying the tax the government think you probably should, which is quite possibly more than it actually needs to be. Going to just put a quick poll up on screen. Do you use a sole limited company, or are you a sole trader? It's always really useful to kind of see. I think as time has gone on, we've seen more and more dentists using limited companies, and actually probably more and more dentists who should be using limited companies. So good to get a bit of a take stock on who's operating as a company.
Yes, thank you, Simon. I think we've pretty much got everyone's responses, so I will end the poll and share results. If you can see that.
Nice. So 76% of you have a limited company in some form at the moment. 24% of people who've answered do not have a limited company. That's interesting. I would probably, I would really like to speak to the 17% of you who don't have, or 24% of you who don't have a limited company. There's probably a good chance that you could save tax by having one. Certainly worth a conversation. It's not the case for everybody, but it's certainly worth having a conversation about whether using a limited company makes sense for you. There's a lot of kind of old, I guess, stigma around setting up a limited company or dogmatic views that actually having a limited company is really difficult. You have bought my practice years ago, I've got debt, I've got an NHS contract, I can't be a limited company, I've already spoken to my accountant about it, I won't save any tax. I hear these things, every week from new clients I'm speaking with. And in most cases, there is a strong case for incorporating. That's the process of setting up and moving your business to a limited company. Lots of advantages to that, which we'll come on to again as we go. For those who don't know, sorry, Jodie, we've got some questions come through.
It's just someone saying you might be a little bit quieter, so I don't know if you could.
Oh, okay. Sorry, I will try and speak up. Limited company, what is it for those who don't know? Well, it's an entity, it's a thing permitted by law to own other assets on behalf of you. So if you own your practice in a limited company, you actually don't own your practice, kind of represented by the dentist at the top. You own your limited company. Your limited company owns your practice. Your limited company runs the business. It pays the staff. It receives the income from the patients. Hopefully it's building up some kind of cash value in this, some cash building up. There's asset value in that company, which you own kind of by extension by being a shareholder. Actually, you also probably run it because you're the director. And I'll expect for a lot of you, you're also probably the main clinician in there as well. What a limited company gives you, though, is a huge amount of flexibility. A limited company has more flexibility over the costs that it can bear on behalf of its staff and its directors. It has a lot of flexibility, and you as the shareholder of a company have way more flexibility over the tax you pay and way more control over the tax you pay. That's why it's kind of a key component to really taking charge of your taxes. I'll just talk about that a little bit more. So as a sole trader, those of you who are sole traders or who maybe were in the past, you will know that kind of regardless of what you're doing with the cash that's left over from a year's trading, actually that's going to be taxed. It could all have gone on debt, and you will be taxed. But I'll go back to the kind of pie chart Ross showed earlier, because I know the practice that comes from, and I know they had no cash. Big tax bill, no cash. It's all gone to the bank. How come I've made profit and I've got no cash left? And that all gets taxed. They've got no cash, but they've got a big tax bill, and that's quite a difficult situation to be in, and one that can be avoided with a limited company. So the corporate tax regime is kind of layered. There's two components to it. The company pays tax on its profit, so that might be exactly the same number as the profit the sole trade created, but actually the company is going to pay half as much tax on it. The company then gets to decide, or the directors of the company then get to decide how much of that profit they share with the shareholders. You get complete control over that number, and that's the bit of extra tax. That's where a huge saving can come in. For every pound you take from a company as a director or as a shareholder, you'll pay about the same amount of tax as a sole trader does. But with a limited company, you get the opportunity to leave a lot of it behind in many cases, save lots of tax. And I can hear you kind of all wanting to say, but it's my money, what can I do with it? It's no good if it's in a company. I'd probably ask you why you want to take it out at that point. Quite often it's a case of, well, I just want it, or I want to put it in a savings account, or I want to buy property with it, and something we'll come on to in a minute. But anything you can do with that money, your company can do with that money, and it just has more to do it with. One other kind of really big, component of limited company is how debt gets dealt with. Now, on the face of it, it's not really any different. Company makes a profit, it has some interest, which does come off the tax, does come off the profit before we calculate tax, unlike when we're talking about EBITDA. Taxable profit does allow for interest. Capital is then repaid. As a sole trader, you're taxed on that number before the capital repayment is made. But as a company, you're not. And the result with that can be, for those of you looking to, maybe acquire the next practice or thinking about incorporating practices and debt restructuring, and even more important with the rates constantly increasing that we have seen over the last 12 months, your tax on a similar amount of debt is so much more as a limited company. And this is showing that on £500,000 worth of debt, a sole trader is paying over 350k in tax across the life of that debt in paying it off. Just because they're paying tax on money they don't get to keep. That doesn't happen with a company. I can kind of cover that in more detail and look at specific circumstances if anybody would like to. I just think it's, you know, quite a hugely powerful graph to show, and accountants love graphs. So some of the other key options, some of the other key benefits of a limited company. Some of these more interesting than others. Some we've kind of talked about already. So in investments, for example, companies can invest in anything you can invest in, and they've got more money to do it with. So if you've earned money in a limited company, let's just say there's £100,000 there. You're saying to me, but Simon, I want my £100,000. I will say that's fine. You can have that. You'll be left with 60. You know, so if that's to deposit to start your rental portfolio, you've got 60. Company can start the same rental portfolio. It has 100. So huge kind of increase there. Hugely more beneficial starting point to kind of wrap your head around the concept of the company being your investment vehicle. Couple of bit easier ones to deal with. Vehicles, company could buy a car for you. Probably only makes sense if it's an electric car, but loads of tax to be saved if that suits you. Insurances, anyone who's bought a practice and has debt probably has life insurance. That won't be tax deductible for sole traders. It can be for a limited company. So if you know, this isn't just for people who are incorporating, but if you already operate a limited company and your life insurance is personal, have a chat with us. We can put you in touch with people who can maybe help improve that for you. Three of the more interesting ones on here, though, other ways to utilize a limited company. I think it's all about gaining every kind of percentage point. You know, the marginal gains that you can get from having a limited company really do stack up. It's not just about leaving your money behind. It's not just about, you know, buying an electric car or having it pay for your insurance. It's about looking at every avenue, unturn every stone. What can this company do that can save me some tax? Because actually, I think the default position is you set up a limited company, you take all the money out, you don't save anything. You've really got to, you know, going back to my earlier slide, actively take control of it to get the best outcome. One way that can help is with your family. So, you know, we speak to many dentists who, the principal dentist of a practice maybe has a husband or wife who isn't a dentist, maybe doesn't earn so much, maybe has another role elsewhere, maybe even works in the practice. Actually, there's a lot of opportunity there to perhaps involve them as a shareholder, share the dividends with them. You're twice the amount of kind of tax reliefs available for everybody, has an impact on tax as the years go by, has a huge amount of impact on tax at exit. You know, we have the possibility of 2 lots of entrepreneurs relief, or what used to be called entrepreneurs relief limit, meaning you could exit at a cost of 10% instead of, you know, maybe 20%. There's things we can do with children. You know, if you've got adult children, perhaps they could take a role in the company as a company secretary or director or employee. There's just loads of options there. You know, I can't tell you every single one. Everybody's case is different, but lots of ways that the family can be involved and a company can help kind of spread that between them. Property is another one, kind of hinted on it already. Companies can own property, whether that's commercial property because they own the building that the practice is in, whether that's rental property because actually you've used your surpluses to create a property portfolio, wealth to pass to the next generation. Another benefit of bringing the family in, you can end up passing the wealth inheritance tax free. Companies can own property and quite often much more tax efficiently. Going back to the debt thing again, they get to pay the capital on the debt at a much lower tax rate than a sole trader or a personally owned property will be. For those of you who do have rental properties, you might be familiar with the restrictions that's come in over the past few years to do with rental interest, mortgage interest, sorry. That doesn't apply to a limited company. They're currently not subject to those rules. So they get full tax relief on the interest and they don't pay tax on clearing the capital. I've saved it till last, and it's probably the one that, from experience, most people are probably most interested in me talking about. But education, a lot of dentists we speak with, kids are in private school. In many cases, it's the largest outgoing they have as a household. The mortgage or a business loan may be bigger, but there's not much else that costs more than private school fees. Huge amount of tax involved in that. So just to kind of illustrate, if it's £15,000 a term for school fees, that's costing you kind of 22 in tax and dividends, basically. To have £15,000 to spend on something, you have to take a dividend of £22,000 from your company. You're giving half the cost of the school to the government in tax. I can't kind of sit here and tell you exactly how we solve that for everybody, but we do have a route that we can apply in many circumstances that will let you access the funds to pay for school fees. And not just school fees, actually, probably anything that is non-business, any kind of lump sum activity, extension on the house, that kind of thing, sports car, much more tax efficiently than that. In fact, over a period of time with zero tax at all. I'd love to talk to kind of anyone who wants to know more about that, but a bit difficult to kind of cover everybody's individual circumstances here and now. Kind of wanted to kind of just close off the evening. So it's really difficult to talk in too much detail about tax without kind of either being really boring or really irrelevant, or you know, kind of digging really deeply into personal circumstances. So I would love to speak to all of you afterwards. Jodie will be following up with some contact details. But I wanted to just show a short illustration of a practice that actually the whole of the Hive group worked on, and Christie and Co helped take the practice to market as well. So this practice was I think a four surgery practice when they came to us. Over a period of a few years of working with Hive, we've increased their turnover by 66%. Our marketing department rebranded the practice, generated the leads that allowed them to turn into a 6 surgery practice. By optimizing the costs and looking at the pie chart, doubled their profitability over a period of time in the run up to a sale. Christie and Co took the practice to market. This was 2001, so I think this was an above average performance for the year, but they received 12% over the asking price. Compared with the value of the practice from when they kind of first came to Hive, we tripled the value of the practice for them. They got a much better exit and a much better income, which they're still benefiting from now. As part of the sale, also, we managed to kind of carve the building out of the limited company. They had quite an inefficient tax structure from a previous advisor. We managed to improve that. We managed to let them keep the building, and at the same time created a large director loan account, which allowed them to access funds at a reduced tax cost in the future. Some of you will be familiar with a director loan account, but essentially that's where you either owe money to or from your company. Lots of people incorporated years ago, they were owed money. That loophole got closed by HMRC, but you know, there are still ways to create them in the right circumstances, which could be hugely beneficial. I'll stop there because I know we've probably had a few questions come through. So yeah.
Yeah, perfect. Thank you, Simon. It's really interesting. So I know that Ross, Jamie and Jonathan have been sort of typing away at some questions that are in there.
I'd probably kind of chip in, Simon. We've had quite a few kind of questions about kind of CGT and
Okay.
kind of how to best harness that, particularly if you're a limited company. I know you'll say kind of each thing's kind of quite case specific, which will be true. You kind of tell people some of the advantages of using a limited company in CGT, because I think that's relevant.
In regards to kind of exiting the practice at sale time. So
yeah, so actually you mentioned about the property restructure there on that last case study as well, but
yeah, okay. It's quite a wide topic, I suppose. I didn't see the actual questions, but you know, broadly speaking, capital gains tax is payable on the profit you make from selling an asset. If you're selling a limited company, which is an often a common way for an exit of when you have a company to kind of take place, you're probably going to go to the seller, to the buyer, and they're going to buy your shares off of you. If you do that, there's a good chance you'll qualify for what used to be called entrepreneurs relief, It's technically now called business asset disposal relief, but most people still know it as entrepreneurs relief. And that will allow, if you qualify, the first £1 million of profit to be taxed at 10%. Anything above that will still be taxed at 20%. So the point I made earlier about maybe sharing that with family is actually, if you're a husband and wife setup, two spouses, you've got £2 million of profit that can be taxed at 10%. There's actually other options as well. So you could look, depending on your circumstances, not to sell the shares, but for the company itself to sell the assets it has. Isn't often the best outcome, but can be. There's a third option actually where you can structure it to have a completely tax-free exit. That sounds like the obvious answer for everybody, but actually, believe me, it isn't. Otherwise, we'd all be doing that. But in the right circumstances, depending on your future plans, depending on the lead time we have to carry out any kind of restructure ahead of a sale, it is actually possible to sell a limited company without paying any tax on the profit you make from doing it. I don't know, Ross, if you think that answers the question.
Yeah, no, that's perfect. I think probably just to kind of pick out the relevant parts there, that I know you had a case as well where a sale £6 million completely tax-free exit, but that was right for that person because there are kind of limitations with it. I know equally there are other situations, again, probably like your case study, where they didn't want to use a tax-free exit, but what you were doing is kind of breaking apart the business and the trading property. So yeah, I'm not trying to kind of dodge the thesis here. It becomes so hugely kind of case specific, but you've got the full kind of tool of, armory of tools to use the right kind of tool for each person.
Yeah, you're right. And it kind of goes back to what's been mentioned a couple of times already about, I think Jamie in particular, one of your slides said, speak with your accountant soon as possible. And actually, I think if you're coming to me tomorrow saying, look, I want to sell in 6 months, it's not as soon as possible. Ideally, we've got years of lead time on this. So, one of the first things we do when we bring on a new client is assess their tax structure, help them understand their future objectives. Sometimes we need 5 years to do certain things in tax. Other times it's 24 months. Sometimes it's 12. But if you're selling within that 12 months, we probably are quite limited on how we can help. We can help you pick the best outcome of what's available, but you're limited on ways you can change it in that short term. But with the right time and in the right circumstances, there's a lot that can be done.
I've also had a couple of questions about, is there a way I could kind of structure it so that I only sell bit by bit every year? And how does that impact CGT?
You can do. You can do that commercially if that's the outcome that suits the buyer and the seller. They can agree to that. Capital gains tax looks at the deal that's been done. So if you've done a deal to say, hey, I'm going to sell you my £1 million business, 100k up front, 300k for 3 years, capital gains tax is going to say what date was that deal done and what price was it done at. Okay, £1 million on day one, that's what we're taxing. There might be circumstances where the tax gets paid over time, over kind of an 18-month period or in line with those slices. But fundamentally, the day a deal is done, the value of that deal gets taxed. More complicated in the kind of deals we see with Dentex and Portman and some of the other corporates where some of it is subject to hitting targets, but the tax will still try to tax as much of it as possible up front.
There's a surprise.
There's lots of things coming into tax designed to get the government their money faster, even if they're not sure it's the right amount.
Thank you. So another question on here. I understood that directors cannot take loans from the company. Is that true?
No, that's not true. So a director loan can operate in two ways. Referred to it earlier, actually probably in a situation where the company owed you money. So that happened a lot in the past. You would give your business to your limited company. It's a piece of paper at that point in time. It's got nothing to pay you. So it says, you know what, your business is worth £1 million. I will give that to you one day in the future. There's a loan there. Your company owes you £1 million. The question is about taking a director's loan. A company can lend you money as well. So if your company has excess cash, it can lend it to you. There's a process to go through to make sure it's kind of compliant with company law and that the board of directors of that company have signed that off, but it can do it. there's tax provisions to be worried about. So a lot of people think it can't be done because it can cause tax. Basically, if there is a loan, the government are assuming the only reason you've taken a loan is because you wanted to avoid a dividend, which you definitely do pay tax on, and therefore they're going to tax it anyway. So if the loan is still there after a period of time, the company pays tax on it, but the loan can still be taken. And actually, if the loan gets repaid at some point in the future, the tax can get repaid. So you can do it.
Yeah.
Doesn't
Your
always work.
skill, Simon, is to try and mitigate and reduce that amount of tax, isn't it, on the director loan?
Yeah.
Lovely. What are the tax implications for selling a squat practice after 10 plus years of operation?
It will depend if you're a sole trader or a limited company, and if you have a company selling its assets, or if you are selling that company. But broadly speaking, for capital gains tax purposes, a squat practice has very little cost. It does have cost, it has a huge amount of cost, but it's not necessarily the cost we take into account when calculating capital gains tax. So broadly speaking, your full sale price may be taxable.
Put the phone to Simon as quickly as possible, I'd say.
Yeah, I'd love to speak to you. Sure, we can help.
Okay, just had one more come in. With an intercompany loan, how long realistically do you have before you have to pay it back without paying tax?
So an intercompany loan is not a director's loan in most circumstances. There's some strange tax rules that can stop that, but roughly, broadly speaking, if a company is loaning money to another company, that does not get taxed. It's only when the company is lending money to a director, added complication of if you go through one company and then out to the director, it can get taxed, but just a loan from one company to another does not get taxed. Otherwise, we'd all be taxed on our loans from Barclays and Lloyds, etc.
Okay, and someone just quickly popped up. Would my accountant not be doing all of this stuff already?
For the sake of the industry, I'd like to say yes, but based on my experience with people that I speak to kind of daily, probably not all of it. Time and time again, we hear questions about, my accountant just doesn't communicate with me. They're not helping me. They're not proactive. I have to go to them with some suggestions, and then they say, yes, I could have done that years ago. I don't feel it should be that way round. So there's a good chance your accountant is not doing all of this for you, sadly. And if you think that's the case, get in touch.
Yeah, definitely. Okay, perfect. Well, for the time being, it looks as though we've sort of come towards the end of the questions. Someone on here has asked, will there be a future session talking about our dental practice marketing services? So I will be following up with everyone off the back of this tomorrow, offering complimentary consultations. So that's with ourselves at Hive, and also Christie and Co. Are more than happy to have conversations as well. So I'll follow up with everyone, whether you want to speak to Simon, Ross, anyone at Hive, or obviously the experts over at Christie and Co. Just respond to my email, and we can get that organised with the relevant person. And as I say, all complimentary consultations in first instance, obviously discussing how we can help you, identifying the areas, and then we can obviously sort of go from there, depending on what services and what you require. Just someone has just quickly popped up though. 10 years ago, I bought a practice through a holding company, not tax on sale, right? I think that's a question.
It depends how you're selling it, but possibly.
Okay, so essentially to round up everything, we are the experts in the dental industry, both Christie and Co. and Hive. So any questions related to yourself, get in touch. We can have the conversation. You've got nothing to lose in having that conversation. It'd be great to hear from you, and we will help in any way that we can. So have that conversation, and then we can go from there. But thank you so much to our panelists today, our dental experts, and for everyone taking the time to listen. As I say, I will be in touch tomorrow and hope to hear from you and see how we can help you.
Thank you all.
Thank you, everybody.
Thanks for joining.
Everyone.